Using discipline and patience and controlling risk are the most important skills in trading. Every successful trading tactic requires discipline and patience. Discipline to stick to the trading plan and patience to wait for the required trading setup to materialize. People often think that discipline is a hard habit to learn and acquire, but think of it from another angle. You stop every time you see a red traffic light, every single time. So, your discipline, in that case, is 100% efficient. You do it effortlessly, without ever thinking about it. You certainly don't think that stopping at a red light is something hard to do. You just do it as if it were second nature. Your discipline becomes your habit, and sticking to the habit is not hard. Sticking to trading rules is exactly the same. You learn rules, stop at a red light, go on a green light, and stick to them, without ever thinking about it. Use your discipline until it becomes a habit. If you patiently and consistently stick to your trading rules, the law of probability will do the rest. Often, when trading, people change their mind and break the rules. They inevitably end up with a minus. There is no point in devising a good trading plan if you are going to deviate from it on a regular basis. In order to be disciplined, one needs motivation. People stop at a red light because they are afraid that someone will drive into them. When trading, people often lack this kind of a fear, as losing money is not such a bad outcome for many. So, you have to find your deepest motivation to maintain discipline in trading. Some traders hate losing money every single time. Their motivation is to lose the least possible amount. Others like the personal sense of accomplishment after having forced themselves to stick to the predefined rules on every single occasion. Purely earning money is rarely the most important motivation behind sticking with discipline. Often there is something at work on a higher level, such that money is simply a byproduct. So, find what motivates you, then use this motivator to your advantage. Don't let material possessions be your motivation for trading. In concrete terms, we have already said that proper risk management is about risking no more than 2 to 5% of your total deposit per trade. That way, you will never face the risk of losing more money than is possible in order to easily recover, relatively speaking. It will also allow you to withstand a possible losing streak without your account being depleted. Finally, if you risk too much per trade, it will blur your ability to make calm decisions by allowing emotions such as fear and the pain of loss to get the better of you. Although there are many different trading tactics out there, as we said before, the safest ones are those where you can earn more than you lose per trade. For example, if you want to risk 30 pips and apply your stop loss accordingly, your potential profit goal should be at least 60 pips or 2 to 1. This is not a rule to be obeyed blindly, but it is good to only concentrate on trades where your odds are much better than your risk. You should only pick scalable trades, that is, those that have a much bigger profit potential than potential loss. Those are usually trends that occur during their early phase. There is nothing heroic in this approach, but by using such safe bet tactics, you will be able to profit even if you only hit 35 to 40% of your trades. The famous trader Peter Lynch said, "In this business, if you are good, you will be right 6 times out of 10. You are never going to be right 9 times out of 10. Some traders use tactics where they risk more than they could earn per trade. That way, they will need to be right most of the time, which is a very tough call to maintain in the long run. It is better to be highly selective in your trades and only enter into one when the situation is clearly to your advantage. Let's imagine 2 fishermen. The first is an amateur who goes occasionally fishing for an adrenaline rush. Although he tries to catch fish, there are no fish at the time of day he went to fishing. So, he loses all his bait without catching anything. We may say that his risk-reward or risk management tactics are bad. The other is a professional who invests his time and patience while waiting for a school of fish to turn up. When it does, it is easy to spot, and he catches plenty of fish without using too much of his bait. His risk-reward tactics are therefore good, as is his risk management. Perhaps he has no more fishing skills than the amateur fisherman, but his discipline and patience will always make him a winner. Now, imagine someone says to the professional fisherman, "You are playing safe, you should risk more because that's what people do. You would be better to risk more so that people will respect you more." This would sound ridiculous, as would a similar sentiment if expressed in a trading context. You should use the safest and easiest way to earn money by trading on the market, which is to enter into trades in the first third of an already well-established trend. Later, we will discuss how to spot a trend early on.